The stock market is hitting all-time highs. Unemployment is down. So why does a simple trip to the grocery store feel like a financial crisis? You aren't crazy, and you aren't bad with money. The truth is, the economy isn't booming for everyone. It actually just split in two. It's called a K-shaped economy, and an invisible line is deciding who gets rich and who gets permanently left behind. By the end of this video, you'll know exactly which side you are on, and the exact steps to escape the bottom. If you turn on the news today, the financial anchors are celebrating. They point to GDP growth, low unemployment, and the S&P 500 smashing through records. On paper, we are living in an economic golden age. But if you walk outside, talk to your neighbors, or look at your own bank statement, the reality is completely different. Credit card debt has surged past $1 trillion. Auto loan defaults are spiking to levels we haven't seen in over a decade. The dream of homeownership feels like a cruel joke for anyone under 35. So who is lying? Are the official metrics rigged, or are everyday people just complaining too much? The truth is, neither is lying. They are just looking at two entirely different economies happening at the exact same time. This is the danger of relying on averages. If you put 9 broke people in a room, and Elon Musk walks in, the average person in that room is suddenly a billionaire. But in reality, nothing changed for those 9 people. Historically, economic recoveries looked like a V or a U. When the economy crashed, everyone suffered. When it recovered, everyone rose together. A rising tide lifted all boats. But after the massive disruptions of the 2020s, a new shape emerged, the K-shaped economy. In this new reality, the middle class hollows out, and the recovery violently splits into 2 aggressively diverging paths. Let's look at the top arm of the K. Who is up here, and why are they thriving? The people on the upward trajectory are largely asset owners, knowledge workers, and those shielded from physical labor constraints. If you own real estate, a stock portfolio, or equity in a business, the last few years have been a historic wealth-building event. Why? Because of how inflation impacts assets. When the cost of everything goes up and governments print money, the value of hard assets skyrockets. If you owned a $500,000 home and a stock portfolio before the inflation wave hit, the devaluing of the dollar meant the nominal price of your assets exploded. You didn't work any harder, but your net worth surged by hundreds of thousands of dollars while you slept. Furthermore, many people on the top arm locked in historically low mortgage rates around 2 to 3% years ago. Their biggest monthly expense, housing, is permanently capped, completely shielding them from the current affordability crisis. Meanwhile, in the professional world, the transition to remote and AI-leveraged work meant tech workers and specialized consultants could scale their output, hop between high-paying jobs, and invest surplus income into a booming market. For the top 20%, inflation isn't a crisis. It's a massive wealth transfer mechanism. Now, let's look at the bottom arm of the K. This is where the majority of the population is currently trapped. The bottom arm consists of wage earners, renters, and essential workers. If your entire income is derived from trading your time for a fixed hourly wage, you are fighting a losing mathematical battle. While asset owners got rich off inflation, wage earners were crushed by it. Yes, wages have gone up slightly, but they have absolutely not kept pace with the true cost of living. The price of groceries, rent, utilities, and insurance has compounded at a terrifying rate. If your rent goes up by 20%, but your salary only increases by 4%, your standard of living collapses. You are working the exact same hours, providing the exact same value, but your labor buys you less of the world. Unlike the top arm, who locked in cheap debt, the bottom arm is forced to navigate the highest interest rates in decades just to survive. Unable to afford the rising cost of basic necessities, millions have turned to credit cards to bridge the gap. But with interest rates sitting well above 20%, this debt compounds faster than any potential wage increase. Because all your money goes toward basic survival and debt servicing, you have zero surplus capital to invest. You are completely locked out of the asset game. How did this divide become so extreme? It all comes down to how money flows through the system. When central banks pump money into the economy to stimulate growth, it doesn't distribute evenly. It flows through the banking system, straight into financial assets. This phenomenon is known as the Cantillon Effect. The people closest to the money printer, large corporations, banks, and wealthy investors, get the money first before prices rise. By the time that stimulus trickles down to the average worker in the form of a tiny raise, inflation has already driven up the cost of everything. The stock market isn't booming because the underlying economy is perfectly healthy for everyone. It's booming because massive corporations use cheap debt to buy back their own stock, consolidate monopolies, and aggressively raise prices on consumers. The record profits you see reported by Fortune 500 companies are literally funded by the diminishing savings accounts of the middle class. This is the brutal reality of the K-shaped economy. It is a zero-sum game. The top arm isn't just growing parallel to the bottom arm. The top arm is extracting wealth directly from the bottom arm. Every time an institutional investor buys up single-family homes to rent back to families at a premium, the top of the K gets richer, and the bottom falls further behind. So if the system is designed this way, are you doomed to the bottom arm? Not necessarily. But surviving the K-shaped economy requires a radical shift in how you operate. First, you must understand that saving fiat currency is a guaranteed path to poverty. You cannot save your way to the top of the K. Your primary financial directive must be acquiring assets. Even if it's starting with $50 a week in an index fund, you must transition from a consumer of goods to an owner of equity. Second, you need to decouple your income from your raw time. The bottom arm is entirely dependent on hourly wages. You must leverage high-income skills like coding, sales, digital marketing, or AI proficiency that allow you to scale your output and demand equity rather than just a paycheck. You want to be the person managing the automation, not the person being replaced by it. Finally, optimize your debt. High-interest consumer debt is the anchor dragging the bottom arm down. Pay off variable rate liabilities immediately, but don't be afraid to use fixed-rate, low-interest debt to acquire income-producing assets. The wealthy don't avoid debt. They weaponize it to buy assets that appreciate faster than the interest rate. The middle class is disappearing. The gap between the owners and the renters is becoming an unbridgeable chasm. The lines have been drawn, and the K is splitting further apart every single day. You can't control monetary policy, and you can't control the Federal Reserve, but you can control which side of the divide you build your life on. Stop trading time for a melting currency and start acquiring a piece of the machine. If this video helped you understand what is really happening in the economy, hit the like button and subscribe for more deep dives into the financial realities they aren't teaching you in school. Let me know in the comments below, what is the craziest price increase you've noticed in your daily life? I will see you in the next one.